In today's world, the specter of inflation looms large, casting its shadow on various aspects of our lives. It's undeniable. Prices are rising, and it's a topic that has gripped the attention of individuals, companies, investors, and politicians alike for the past year and a half. In this discourse, we embark on a journey through a spectrum of investment categories, deciphering their performance in times of inflation. Our guide through this labyrinth is none other than the venerable Warren Buffett, a man whose 91 years on this planet have endowed him with invaluable insights into the intricate dance between investments and inflation. To glean wisdom from the Oracle of Omaha himself, I delved deep into hours of interviews and musings, all to bring you this distilled knowledge. All I request in return for this endeavor is a simple gesture. Tap that like button, and perhaps consider subscribing to our channel if you haven't already. With that, let's delve into the heart of the matter. Amidst the tumultuous waters of inflation, the most treacherous investment vessel to sail is cash. Warren Buffett's aversion to hoarding cash during inflationary times is shared by the likes of fellow billionaire Ray Dalio, who famously dubbed cash as trash. The rationale behind this sentiment is clear. As inflation marches on, the value of cash stashed away in savings accounts or beneath your mattress dwindles with each passing day, week, month, and year. Herein lies a pivotal takeaway. Investors must evaluate their returns through the lens of real terms. The calculation behind this concept is straightforward. Let's assume your investments yield a respectable 10% annually. Sounds promising, doesn't it? Well, not so fast. The true measure of success hinges on the inflation rate. To ascertain your real return, you must subtract the erosive effects of inflation. For instance, if inflation stands at 7% and your investments generate a 10% return, your real gain is a mere 3%. Suddenly, the allure of your 10% return loses its luster, doesn't it? This stark reality is why cash finds itself at the bottom of our investment hierarchy, for the return on holding cash is essentially zero. Over an extended period, inflation stealthily erodes its value, leaving you with a diminished purchasing power. Above cash in our hierarchy are fixed interest rate bonds. Conventional wisdom often touts these investments as bastions of safety. However, both Warren Buffett and I would argue that their safety is somewhat illusory when the corrosive influence of inflation is factored in. Allow me to elucidate. Fixed interest rate bonds offer a predictable stream of income, making them a favored choice for risk-averse investors. Yet, in the throes of inflation, they fall short of preserving wealth. The crux of the matter lies in the static nature of these bonds. While they may safeguard your principal, they struggle to keep pace with rising prices. As inflation erodes the value of money, the purchasing power of your fixed bond interest diminishes. In essence, you find yourself in a paradoxical situation where the safety of your investment leads to a real loss in value. The disconcerting reality is that during times of inflation, even seemingly safe investments can turn treacherous. Fixed interest rate bonds, once hailed as beacons of stability, lose their shine in the face of eroding purchasing power. Thus, the astute investor must navigate these uncertain waters with caution, always mindful of the complex interplay between returns and the relentless march of inflation. In the subsequent segments of this video, we will continue our exploration of investments during inflation, gradually ascending the hierarchy to unveil strategies that can help you not only weather the storm, but also thrive in its midst. The current yield on a 10-year U.S. government bond is approximately 1.8% as of the making of this video. This means that if you were to invest in a 10-year government bond today, you would secure a 1.8% annual return for the next 10 years. However, let's consider a scenario where inflation averages 4% over the next decade, which is a rather conservative estimate, given that recent inflation reports have indicated rates as high as 7%. With 4% inflation, your annual real return after factoring in the impact of inflation would be a negative 2.2%. While this is still better than holding cash, it falls far short of optimal investment. It's worth noting that individuals holding fixed-rate debt, such as government bonds, tend to lose during inflationary periods. Conversely, Those who have borrowed money at a fixed interest rate for a longer term are poised to benefit. An excellent example of this is individuals who use a mortgage to purchase a property. In December 2020, I personally acquired a house and secured a 30-year fixed-rate mortgage at 2.8%. This means that my interest rate remains constant for the next 3 decades, and so does my mortgage payment. This financial arrangement is advantageous during inflation because the decreasing value of each dollar due to inflation gradually erodes the real value of the mortgage debt. As inflation diminishes the purchasing power of money, I get to repay my mortgage with less valuable dollars. However, in the case of someone owning a property with a substantial mortgage and experiencing significant inflation, the inflationary effect can effectively wipe out the mortgage debt, leaving them with a valuable asset. Moving up the hierarchy of assets during inflation, Warren Buffett refers to unproductive assets such as gold, silver, and other precious metals. These assets aren't inherently bad to hold during inflationary periods because theoretically, they should at least keep pace with inflation as the prices of other goods and services rise. However, it's important to understand that these unproductive assets are unlikely to substantially increase your purchasing power either. Warren Buffett offers an illuminating perspective on gold. If you were to gather all the gold in the world, it would roughly form a cube measuring 67 feet on each side. In today's market, this cube of gold would be worth approximately $7 trillion, which is approximately a third of the total value of all stocks in the United States. You're essentially faced with a choice between owning a third of all U.S. stocks or possessing a small inert block of gold that doesn't generate income or dividends. While gold can have its allure, it doesn't offer the potential for wealth creation and income generation that productive assets like stocks can provide. In contemplating the vastness of wealth in today's world, Warren Buffett's wisdom serves as a guiding light. With $7 trillion at your disposal, you can lay claim to approximately 1 billion acres of American farmland, a collective treasure valued at around $2.5 trillion. Such an investment is a testament to the staggering scale of agriculture in the United States, where nearly half of the continental expanse is dedicated to farming. Picture this. You could own every expanse of fertile soil, from the cotton fields of the South to the golden cornfields of the Midwest. Your portfolio would swell with the bounty of soybeans, and you'd have the equivalent of 7 ExxonMobil corporations under your wing. Additionally, you'd still have $1 trillion of liquid assets to spare, money you could carry around with you, ready for any opportunity that beckons. Now imagine being presented with a choice, a 67-foot cube of gold, a dazzling but inert spectacle that merely glistens, or the entirety of the nation's farmland, teeming with life, growth, and productivity. The cube of gold, no matter how opulent, stands motionless, while the farmland hums with activity. It's a realm where crops thrive, where nature's bounty unfolds, and where economic sustenance flourishes. Some might call it audacious, others might label it a leap of faith, but the logical choice seems clear. Farmland and productive assets with their potential to create, to nourish, to evolve, and to generate lasting value outshine the luster of gold. Transitioning to the next facet of our investment journey, we move beyond the realm of mere preservation of wealth in the face of inflation. We embark on a quest for assets that not only weather inflation's storm, but actively thrive, delivering substantial, tangible returns. This is where Warren Buffett's emphasis on productive assets assumes paramount importance. Warren Buffett, the legendary investor, carved his fortune through strategic stock investments and the acquisition of entire businesses. However, he has always maintained that not all businesses are created equal. Enter the category of average businesses, a distinctive breed characterized by their insatiable appetite for capital, often referred to simply as cash. Herein lies a crucial distinction. In times of inflation, most businesses find themselves in an uphill battle, striving to retain their value amidst a relentless devaluation of currency. The earnings of these enterprises might indeed witness an upward trajectory, but this is counterbalanced by their incessant need for more capital just to remain afloat. Such businesses, in effect, demand an ever-increasing commitment of resources without commensurate growth in earnings, a less than ideal proposition for investors. To illustrate this principle, consider United Rentals, denoted by the ticker symbol URI, the world's foremost equipment rental giant. United Rentals operates by procuring equipment, including heavy machinery like bulldozers, portable restrooms, and robust trucks, commonly used in construction endeavors. Subsequently, they lease this equipment to construction projects, typically for the duration of the project. Here's the crux of the matter. The equipment in United Rentals' inventory isn't immortal. It necessitates periodic replacement. Take, for instance, a bulldozer, which costs the company $1 million to acquire. Over its operational lifespan, this bulldozer generates $1.2 million in revenue. It's an apparently profitable venture, with a $200,000 surplus. However, under the lens of inflation, the picture grows complex. As the value of currency erodes, the cost of acquiring new equipment surges, thereby diminishing the real return on investment. In essence, the business model obliges constant infusions of capital to maintain operations at status quo. This exemplifies Buffett's discerning perspective on businesses and underscores the wisdom of directing investments toward productive assets that can not only endure inflation's onslaught, but flourish in its wake, delivering genuine, appreciable returns. So, as we navigate the multifaceted landscape of inflation and investment, let us heed Warren Buffett's counsel, recognizing that the allure of gold pales in comparison to the enduring value and potential of farmland and productive assets. In our pursuit of financial resilience and prosperity, these choices beckon as pillars of wisdom in a volatile world. In a hypothetical scenario, let's consider the impact of inflation, where we assume a rather extreme rate of 20%. To illustrate this, we'll take the example of a company, United Rentals, which specializes in renting construction equipment like bulldozers. Imagine that United Rentals needs to replace one of its bulldozers, and the cost for a new bulldozer now stands at $1.2 million due to the 20% inflation rate. Here's what's happening in this situation. United Rentals can't withdraw any profits from its business because all the earnings it generates have to be reinvested immediately to purchase new equipment, essentially maintaining the status quo. Now, I must emphasize that I don't foresee inflation reaching such staggering levels, but this example highlights a crucial challenge faced by capital-intensive businesses during inflationary periods. Before we proceed, I'd like to share an anecdote that encapsulates this concept well, courtesy of Warren Buffett's partner, Charlie Munger. Munger once said that there are two types of good businesses. The first type generates profits that essentially sit as surplus cash at the end of the year, which can be withdrawn from the business without hindering its performance. The second type reports profits on paper, but there's no actual cash available. It's akin to a business where every year you make a profit, but that profit is locked within the business, and there's never any cash to show for it. This dilemma resembles the situation in the used construction equipment business, where profits seem to vanish into thin air. Moving on to another characteristic of businesses to avoid during inflation, let's talk about the importance of having pricing power. To understand what this means, consider a company like Apple. Apple commands tremendous loyalty among its customer base, to the extent that many are willing to pay a premium for their products, including iPhones. Even if a new iPhone comes with a hefty price tag, Apple's devoted customers are unlikely to switch to a cheaper competitor. This is what we mean by pricing power. Now contrast this with a company that lacks pricing power, like a manufacturer of plain white t-shirts without any unique designs or branding. Such a company faces intense price competition, with customers primarily concerned about finding the cheapest option available. This manufacturer cannot increase prices beyond its competitors because doing so would drive customers away. During inflation, this situation becomes particularly challenging. The costs of materials, labor, and shipping all rise, but the company can't raise its prices accordingly. In essence, the only thing not increasing is the price the company can charge for its shirts. This lack of pricing power makes it difficult for the company to maintain profitability in an inflationary environment. Now, let's transition to the next category of investments, which we'll refer to as productive assets or great businesses. The name may sound simple, but these investments hold significant potential. In the world of investing, there are few names as legendary as Warren Buffett. Known for his incredible track record of success and his ability to consistently generate wealth, Buffett is a true master of his craft. In this video, we'll be taking a closer look at one of Buffett's key strategies for making money during times of inflation. To begin, let's consider a hypothetical example. Imagine that our friend John has $1 million to invest. In one scenario, John spends that money on a bulldozer for his business. In another scenario, John uses that same $1 million to develop a software product that helps creators on YouTube make videos. In the first scenario, John's business generates $1.2 million in revenue during its first year, resulting in a profit of $200,000. However, if there is 20% inflation during that year, John will need to reinvest a significant portion of his profits just to maintain the business. This is known as a capital-intensive business, and it can be challenging to generate significant returns during times of inflation. On the other hand, John's software business is what's known as a capital-light business. This means that John doesn't need to constantly reinvest large sums of money back into the business just to maintain its operations and product. As a result, John can take his profits out of the business and doesn't need to constantly reinvest his profits back into maintaining the business. So, how can you identify businesses that perform well during times of inflation? The key is to look for businesses with low capital requirements. These are businesses that don't need to constantly reinvest large sums of money back into the business just to grow. Examples of these types of businesses include those with strong brands, like Apple or Coca-Cola, or those that don't rely on owning physical assets, like Microsoft or Facebook. Another important factor to consider is pricing power. During times of inflation, prices are rising, so you want to own stock in companies that are able to easily increase prices for their goods. This means avoiding investing in companies and commoditized industries that struggle to raise prices even during normal times. Finally, it's important to invest in yourself. If you're the best at what you do, you make yourself immensely valuable to other people. This means that you can charge whatever you want for your services, and your customers will be happy to pay it. By investing in yourself and becoming the best in your field, you can protect yourself from the effects of inflation and ensure that you continue to generate wealth for years to come. In conclusion, Warren Buffett's strategy for making money during inflation involves investing in businesses with low capital requirements and strong pricing power, as well as investing in yourself and becoming the best in your field. By following these principles, you can generate significant returns even during challenging economic times.